Welcome back to The Explainer. Today, we're putting on our detective hats to solve a massive, multi-million-dollar paradox buried deep inside BioCryst Pharmaceuticals' Q1 2026 earnings report. If you actively follow biotech equities, you already know that reading an earnings report is, well, rarely as simple as just glancing at the bottom line. But BioCryst's recent filing, it's literally the textbook example of why we absolutely have to dig past those headline numbers.
Look, when you open up a quarterly report and the first thing you see is a staggering $701.6 million GAAP operating loss, your immediate instinct is probably sheer panic, right? That is a colossal deficit for just one single quarter. And in the high-stakes, fast-paced biotech world, a cash burn that massive usually flashes giant red warning signs, signaling serious operational distress or a commercial strategy that's just totally falling apart.
But wait, because here's where the mystery really gets wild. How on earth can a company that's bleeding over $700 million simultaneously post double-digit revenue growth? And not just that, how does it also maintain a consensus strong buy rating from Wall Street analysts, with an average price target pointing to a jaw-dropping 153% upside? Seriously, it's like these numbers exist in totally parallel, contradictory universes.
So here is our roadmap for today's investigation. First up, we'll lay out the Q1 earnings paradox. Then we'll unpack that massive $701 million loss. Third, we'll look at their core engine, Orladeyo. Fourth, we'll dive into the pipeline and new partnerships. Fifth, we'll check their financial health and ratios. And finally, we'll get Wall Street's official verdict. Let's get right into it.
Section 1. The Q1 Earnings Paradox.
The disconnect here really couldn't be any more obvious. On the earnings call, CEO Charlie Gayer paints this incredibly rosy picture of a company with, in his own words, continued strong execution and sustained progress. He was specifically highlighting their capital efficiency and strategic wins. Now, that super confident tone seems completely unhinged when you're looking at a headline-grabbing financial crater, right? I mean, someone has to be wrong here. Either the balance sheet is screaming a dire warning, or the management team is looking at something the raw GAAP number totally obscures.
Which brings us to Section 2, unpacking that $701 million loss.
To figure out what's really going on, we gotta peel back the layers of that massive deficit. And spoiler alert, the main culprit isn't crashing sales or out-of-control administrative costs. No, it's actually a one-time, non-cash charge of roughly $698 million for something called acquired in-process R&D. This stems directly from BioCryst buying Astria Therapeutics back in January 2026. Basically, in accounting speak, this is treated as an asset acquisition. Think of it like buying an incredibly valuable but totally unfinished scientific prototype and all its intellectual property. Because its future success isn't 100% guaranteed, the accounting rules basically force the company to take a massive one-time expense hit right out of the gate.
The difference between those rigid accounting rules and the company's actual day-to-day reality is honestly kind of shocking. When you adjust for that one-time acquisition charge, plus a few standard things like stock-based compensation, the real operational picture emerges. And it's a highly reassuring $54.2 million non-GAAP operating profit. Actually, scratch that. It's not just reassuring, it's growing. That is up from $43.5 million in the exact same quarter last year. So the core business, it's not bleeding cash at all. It's actively, consistently profitable.
Moving on to Section 3, the core engine, Orladeyo.
Now that we've cracked the accounting mystery, let's talk about the actual engine driving that operational profit. Orladeyo is a treatment for hereditary angioedema, or HAE. For those who don't know, this is a rare genetic disorder where patients are missing a crucial blood control protein. It causes sudden, intensely painful, and frankly life-threatening swelling under the skin or in the organs. Because these attacks strike out of nowhere, patients need really reliable, ongoing preventative medication. BioCryst stepped up with a highly effective once-daily oral pill, which is a huge deal compared to having to take injections. From a market standpoint, this is a highly stable, deeply specialized niche that BioCryst is serving incredibly well. And you can see that market success clear as day right here. New prescriptions have stayed super strong, driving an impressive $148.3 million in Q1 2026 alone. That's a rock-solid 11% year-over-year growth. And you know what's even crazier? If you back out the European Orladeyo business, which BioCryst sold off in late 2025, management pointed out that their comparable growth rate is actually 21%. This drug is an absolute workhorse. It's the financial anchoring the entire company.
Let's jump into Section 4, Pipeline and New Partnerships.
So, with that core engine humming along beautifully, what are they doing with those newly acquired assets? Remember that massive $698 million upfront accounting hit we just talked about for the Astria acquisition? Well, it is already paying strategic dividends. BioCryst literally just landed a massive $70 million upfront cash injection by licensing out the European rights for navempinabart, which is the star drug from that exact acquisition, to an affiliate of Neopharma Gentili. Plus, this deal sets them up for up to $275 million in future milestones, not to mention tiered royalties ranging from 18 to 30% on net sales. Talk about a quick return on an investment, right?
This level of capital efficiency is exactly what you dream of seeing in a biotech firm. It gives them the cash to rapidly push key trials forward without endlessly diluting their shareholders. Right now, they're enrolling their pivotal Alpha Orbit study for navenibigard in HAE, targeting a U.S. regulatory filing by late 2027. They're also pushing forward a phase 1 trial for a drug treating Netherton syndrome, which is a really severe rare skin disorder. At the same time, they were smart enough to kill off another drug for diabetic macular edema. They are ruthlessly cutting the dead weight to maintain an absolute laser focus on high-value rare diseases.
Section 5. Financial health and ratios.
So, what does all this smart wheeling and dealing mean for their actual immediate liquidity? If you look at the balance sheet right at the end of Q1, BioCryst was sitting on $260.8 million in cash and investments. But, and this is a big but, when you factor in that $70 million upfront payment from the European licensing deal that hit right after the quarter closed, their pro forma cash position balloons to a very comfortable $330.8 million. That is a massive financial cushion to keep their pipeline and commercial gears turning smoothly. And if we zoom in on the hardcore financial metrics, their quick ratio is sitting pretty at a super healthy 1.78. For the finance nerds out there, you know the quick ratio is a brutal stress test of a company's ability to pay off its short-term debts using only its most liquid assets. Anything over a 1.0 means a company could literally pay off all its immediate bills tomorrow and still have cash left over. At nearly 1.8, BioCryst proves they are standing on incredibly solid ground, totally shattering any panic that big, scary gap loss might have caused initially.
Finally, Section 6. Wall Street's verdict.
We've laid out all the evidence, cleared the accounting smoke, and well, it turns out Wall Street wasn't fooled by that gap loss for a second either. Across a diverse poll of 10 analysts, BioCryst holds a rock-solid consensus strong buy rating. They've slapped an average price target of $21.30 on this stock. When you put that next to its current trading price down in the $8 range, Wall Street is basically forecasting a staggering 153% upside over the next year. They see exactly what we've uncovered: the relentless growth of Orladeyo, the brilliant capital moves, and the huge potential locked inside those newly acquired pipeline assets.
So, with the mystery completely solved, the true picture is undeniably clear. That massive loss was just a one-time toll on the highway to building a high-value rare disease pipeline, fully funded by an incredibly profitable commercial drug. I'm going to leave you with this final thought to chew on. Given their robust pipeline, an absolute powerhouse of a revenue engine, and a proven knack for killer strategic partnerships, is BioCryst's future exactly as bright as the analysts forecast? It is a fascinating reminder of why you absolutely have to read past the headline numbers. Thanks for hanging out with me on this explainer, and always keep your eyes on the data.